Everyone is screaming that Michael Saylor is about to blow up. Forced to sell Bitcoin, that's what you see on X. Bankruptcy, the whole thing. Maybe they are wrong. Maybe the real risk is simpler and scarier. And it's just one word, leverage. And the proof? 𝗏𝗏𝗡 just did the exact same thing, the safe way. And I'll show you. Here's the deal. The panic you are hearing about strategy is aimed at the wrong target. It's not bankruptcy. It's not even the dividend. It's leverage on an asset that earns nothing. And by the end of this, you will see exactly why that matters. And that's to your Bitcoin. So let's start with what everyone's panicking about. Saylor will be forced to dump Bitcoin to pay the dividend. It's everywhere. It sounds terrifying. And on its own, it's mostly wrong. And here's why. First, there is no margin call. His Bitcoin isn't locked or is collateral. The debt doesn't come due until 2032, 2032, and it gets better. An analyst, Adam Livingston, ran a brutal test, and he asked what if Bitcoin crashes 55%, down to 26,000. Market shed cash burn. The result? No bankruptcy, no death spiral. The company survives, still holding 700,000 Bitcoin. So forget the bankruptcy story. The real damage is somewhere else. So here's the company lives, but you don't. In the same test, the Bitcoin behind each share collapses from 138,000 sats to under 8,000. And the share price? Model at $1. $1. The company survives, your money is gone. And here's the part that should scare the whole market. Even when it survives, it still sells. In that model, 115,000 Bitcoin dumped over 3 years. And that selling doesn't stay his problem. It becomes our problem. Now, you might be thinking, isn't that what these treasury companies do? No, and I can prove it because 𝗏𝗏𝗡, the Bitmain guy, runs the same playbook without the risk. Let's watch. Saylor sells a product called Stretch, a $100 share that pays you a yield. 𝗏𝗏𝗡 just copied it, called it BMNP. Same wrapper, but look at the rate. Saylor pays 11.5%. 𝗏𝗏𝗡 pays 9.5%. The riskier one pays more. The safer one pays less. Remember that it's the whole game. Here's why side by side. Saylor asset is Bitcoin, and Bitcoin earns nothing, zero. So to pay you, he has to issue stock or sell Bitcoin. 𝗏𝗏𝗡 asset is Ethereum, and Ethereum pays him staking. He's staking income $258 million a year. Again, $258 million a year. Covers it 9 times over. One of them earns the yield. The other one has to manufacture it. It's the same product, but with an opposite engine. Now, here's the truth. Nobody's saying this out loud. The villain isn't the treasury companies. It's leverage. 𝗏𝗏𝗡 pays a yield, his asset earns. Saylor pays a yield, his asset doesn't. So he borrows, he dilutes, and he sells. Same wrapper, totally different risk to the market. And that leverage bet, it's enormous. Saylor holds 847,000 Bitcoin, 4% of all the Bitcoin there will ever be, and closer to 6% of what's actually liquid. One company, one man, 6% of the supply. That's a single point of failure for the market. Now, a slow sale over 3 years, the market can handle that. But a regulator or a court forcing a fast dump, that's a different story. And yesterday was the first crack. A law firm opened a probe claiming strategy misled investors. Now, let's be fair. It's a class action firm, not the SEC. It might go nowhere, but it shows the path is open. And this is why it's not his problem and it's yours. 6% of the supply, the liquid one, dumped into a market already terrified. Bitcoin 160,000 that doesn't just hit Saylor, it hits every miner, every holder. You. That is the most under risk price in Bitcoin right now. Now let me be straight with you. Both ways, Saylor is not going to bankrupt tomorrow, or the odds of a forced sell this year are around 10%, not the base case. And Tom Lee isn't a saint either. Bitmine is down 40%, it dilutes its own shareholders. But here's the difference. Bitmine risks hits its holders. Saylor risk hits all of us, because that's leverage. So here's what actually you need to watch. 4 things. 1. The lawsuit. Does it grow? Does any regulator move? And this will be the real signal. 2. MNAV. Is the stock worth less than its own Bitcoin? Then 3, of course, stretch against $100, the stress gauge that everyone is talking about. And 4, is Saylor actually selling? The test sale was the first sell. So here's the bottom line. It's not the dividend, it's the leverage. Tom Lee proved you can run this playbook without threatening the market. Saylor can't. His asset earns nothing and his stack is too big to fail quietly. Watch the lawsuit. Watch the sales. Now you have everything that you need to watch. You have the watch list. You know what's the real danger with Saylor. Of course, in my opinion, it's not financial advice. And I hope you enjoyed this video. Leave the comment at the end. I really want to know if you think Saylor is going to have problems with the regulators, if it will be forced to sell over 3 years, like the example that I just gave you, and if Tom Lee is going to suffer the same fate, or if Tom Lee Bitmine is more solid and protected against this, because as I showed you, it has no leverage. I'll see you all in the next one.